Hello, beautiful people, and welcome to another edition of the ITU Forex class. In this week's edition, we're going to be taking a closer look at some basic forex trading terms which you need to have a proper understanding of in order to build a firm foundation upon which you're going to be laying the pillars of a consistently profitable forex trading career. Okay, so we're going to be needing to talk about these terms because I've noticed that a lot of beginners, especially struggling traders, tend to just skim through these terms. Okay, when they begin learning how to trade, they don't take the time to properly understand these terms and how they affect them when they go about their trading careers. Okay, and that's why we're going to be taking a closer look at these terms today. So without any further ado, let's dive right into it. Okay, so first things first, the first term which we're going to be talking about in trading is known as the forex itself. Okay, so if you've been involved in forex trading, you've probably heard it thrown around. Okay, forex this, forex that. But what exactly does forex mean? What exactly does it mean? So let's break it down like this. Okay, so the word forex, if you take a close look at it, you see this is how it is spelled: Forex. Now, this is not by chance or by coincidence that it's spelled like this. Okay, it's because forex, like you know by now, refers to foreign exchange. Okay, and when we say forex trading, this simply refers to the act of trading currencies within the forex markets, okay, within the global foreign exchange markets. Now, the first two letters of the term forex is just an abbreviation from the term foreign. Okay, so let me spell it this way. Excuse my handwriting. Well, the last three letters of the term forex refers to exchange. Okay, so this word forex was derived by getting the first two terms of the word foreign and the first three. Okay, sorry, it's the first three terms, FOR. Okay, and then the first two letters of the word exchange, and that's how the word is born. Okay, so what does it refer to? Well, forex, like I told you, is the simultaneous exchange of one currency for another. So for example, let's say I wanted to travel to the United States. Okay, the thing is, the naira's in my pocket. If I was to go to the United States and try to buy something, pay for goods and services with the naira in my pocket, most of them are just not going to accept it because in the United States, that might not be their legal. It's not even their legal tender. Okay, so somebody might, when you take a bottle of Coke, maybe from the grocery store or something, and you try to pay someone in naira, he's going to look at you funny and be like, you know what, pay me money. This is not the money we accept here. And this is one of the reasons. This is one of the driving forces of foreign exchange, because for one country to do trade with another country, or for the citizens of one country to be able to engage in trade with the citizens of another country, they need to trade with a currency that is acceptable between both of them. And this brings the need for the exchange of one currency into the currency of another country so that the trade can be facilitated. Okay, so that's what it simply is. Okay, now we've talked about forex, which is the right thing to do because that's one of the biggest terms in the industry. The next thing we're going to be talking about is pip, because I'm pretty sure you've been hearing about pips. You know, when traders are trying to make money or talking about how much money they lost on a single trade or whatever the case might be, you might hear them constantly referring to pips. Oh, I made 10 pips, or I made 20 pips, or I lost 100 pips, or something like that. Okay, so what exactly is a pip? A pip simply refers to the smallest unit of measurement for a currency pair. So when we take a close look at this a currency pair like this, for example, you'd notice that its price is quoted. Let me quickly clean what I've drawn on the charts here. So you notice that the price is quoted in 3 decimal places. So this is a Japanese yen pair, which simply means that the currency is paired with a Japanese yen. You can see that this is GBP JPY. So we have the British pound being paired or being traded against the Japanese yen. In this case, the price of this particular currency at the moment, which is the exchange rate, is you can see it's fluctuating, but give or take, would say is around 157.90. Let's say 912, but 90. Okay. So what does this mean? What does the exchange rate even mean before we start talking about a pip? This simply means that for you to be able to buy one British pound, since this is the GBP JPY currency pair, you're going to need to pay 157.908 Japanese yen. So if I wanted to buy one British pound and I went to the currency exchange booth, I would need to take 157 Japanese yen and give the currency vendor and tell him to give me £1. On the other hand, if I wanted to sell one British pound in exchange for the Japanese yen, I'm going to be getting paid 157.918 Japanese yen for one British pound at this particular moment in time. Okay? So now that we understand this, the last currency pair, as in the last number of this particular currency pair, this is what is referred to as the pip. That's the smallest unit of exchange. Okay? So let me show you this quickly so that you can understand it better. You see, we're talking about the price of this currency pair. And the price is 157. This is just an estimate because you see that the price keeps changing, and that's because currency exchange rates keep fluctuating based on the forces of supply and demand in the market. Okay, so the price is 157 at the moment, 0.90. Let's just say 0.90. But you can see it's not just 90. We have one other digit there. Now, for this particular number here, what is going to be the smallest change in its price? What's going to be the smallest unit of change? This is going to be 0.001. Why? Because the smallest change that you can have in the price of this currency, I'm not talking about change, like a big massive change in the number of the currency or anything. No, I'm talking about the the smallest change that can occur in this particular currency pair to this decimal. This is 0.001. And this is what is referred to as a pip. Although I would like to make a caveat here that a pip, just like we had in the past, people thinking, for science students that are here, we've had the thoughts that an atom is the smallest unit of of matter, and it's indivisible. You have nothing else. But then, as we advance and get more tools and everything, we've now found that not only is it that an atom is not the smallest, but we also have smaller particles. Okay, so in this case, we've got what is known as a pipette. But for a pipette, it's going to be, for a currency pair like the Japanese yen, the fourth decimal place. That's any slight change in the fourth decimal place. That is what a pipette is. So for this particular, just to make it easy for you to understand, we're talking about the change of a number for the third decimal place for a currency pair which involves the Japanese yen. And for currency pairs other than the ones that involve the Japanese yen, for the ones that involve the British pound, for the United States dollar, for example, you might have a price which would be something like, let's say, 1.2700. In this case, the pip value, the smallest change, is going to be 0.0001. Okay? This is what is going to be a 1 pip for this particular currency pair, while a pipette is going to be a change in the fifth decimal place. For a pipette, for this particular currency pair, which involves Japanese yen, is going to be a change in the fourth decimal place, while for regular United States dollar quoted currencies, that's going to be the change in the fifth decimal place. Okay? So a pip is the change in this particular figure. Okay? So what does a pip have to do with anything? Well, when you're measuring distance, for example, you might be measuring in meters or kilometers or all of these things. In the foreign exchange market, we measure price movements, that the distance that price has moved, the exchange rate of a currency pair has moved from one place to another by the term pip. So depending on how big a lot size you're trading with, when price moves like 100 pips, then the money you're going to make as a result of this, if price moved in favor of your trade, will be based on the lot size that you're trading and how many pips you're able to make in profit. Okay, so for this particular example, to help you understand this, let's assume you took a trade when price was all the way up here. Okay, now when price was all the way up here, you can see that when we take a close look at the price around here, is around 188.53. Let's just say 188.50. Now for price to have moved from here, let's say you shorted, to all the way down here, then it would have moved around 689 points. But if you want to talk about pips, then you move it to one decimal place. So it would have moved around 68 pips. Okay, so this is how a pip, this is the use of a pip. A pip helps you to know how far a currency pair has moved. And depending on the lot size that you are using to trade, that's how you measure the profits that you make. But the beauty about Forex trading is that you don't need to do these calculations yourself. Everything can be automated. Everything is even automated. Once you just place a trade, let's say you wanted to place a trade with a lot size of 0.55 or whatever lot size. Let's say you've already done your lot size calculations and you know exactly how much you want to risk. So when you place the trade, you're not the one who is going to be calculating, okay, now price has moved 1 pip or 2 pips or this, so I'm going to be making this. Everything is done automatically. You can see for this particular account, I have a trading position which is open. And you can see it's changing. The pip value, the points is changing here. And this is the profit that I'm getting from the trading position. So I don't need to do this calculation myself. The platform does it automatically. So I know the reason why I'm mentioning this is because I know some of you might start getting scared because, you know, the explanations, oh, a pipette, this and that, and it's maybe starting to turn your head. You don't need to do it yourself. All you need to do is have a strategy that you're trading with. We've talked about this multiple times in the classes, and then use proper risk management and everything, and every other thing is going to be taken care of for you. Okay, so we've talked about what a pip is, we've talked about what a pipette is, and we've also talked about what a currency pair is, but we're going to elaborate on that. Okay, so a currency pair simply refers to two currencies which are traded against each other. For example, this particular chart that you're seeing is a currency pair. The currency pair is the GBP against the JPY. And like I told you earlier, when you're trading the GBP against the JPY currency pair, you are buying 1 unit of the British pound and paying for that in Japanese yen, or you're also selling 1 unit of the British pound and getting paid in Japanese yen. Okay? So why do we trade currencies in pair? Well, to answer that question, I would ask you another question. If I came up to you and I told you that here's a 1,000 naira note in my hand, how much are you going to buy it? How much are you going to buy it in naira? So I simply mean that, let's say I came up with 1,000 naira and I gave it to you and I said, how much would you buy it in naira? I'm not talking about you buying that 1,000 naira note from me and paying maybe in SEFA or United States dollar or euros. No, I'm saying you are buying that 1,000 naira and paying me in naira. You see, the thing is, if you were to pay me anything more than 1,000 naira, then I would have tricked you into a trade that is obviously a losing trade for you. Or on the other hand, if I was to agree for you to pay me anything less than 1,000 naira in exchange for that 1,000 naira that I'm going to give you, then I'm shortchanging myself. And that's one of the reasons why one currency cannot be traded against itself. Okay, you need to trade for a currency exchange to take place. You need to trade one currency against the currency of a totally different country. Okay, and that's how the values are going to keep fluctuating. Okay, so that's why we don't trade currencies all by themselves. So you're not going to see something like the NGN, the Nigerian Naira, against the NGN, for example. That's why you're going to see something like, for example, maybe the USD against the NGN, if we're using this as an example, or the British pound, okay, against the United States dollar, or the euro against the United States dollar. It's always going to be something like this, fluctuating, okay? So again, that's that for that, okay? Now we're going to move on. Apart from the pip, which we've explained, and currency pair, which we just explained, and also the exchange rate, because the exchange rate is simply the price at which a trade between the currency is going to be taking place. The next time which we're going to be talking about is the spread. So the spread is a tricky one, because this is one of the ways that the brokers who facilitate the trading platforms for you to place trades on get paid. So this is an example of what the spread looks like. Let me quickly show this to you, okay? Okay. Okay. So what we have here is the difference between the bid price and the ask price is what is referred to as the spread. So what is the bid price? The bid price is the price at which you sell a currency pair, okay? So let's say you wanted to sell 1 unit of the Euro USD. So in this case, remember what I told you earlier on. The first currency in a currency pair is known as the base currency, while the second currency is known as the quote currency. So this particular currency pair for the Euro USD, the base currency, which is the first currency in the currency pair, is going to be the Euro, while the quote currency is going to be the United States dollar. For the second pair, this is the GBP USD. So in this case, the first currency is the GBP and the second currency is the USD. So the base currency is the GBP and the quote currency is the USD. The same thing, USD CHF, base currency USD, quote currency CHF. The same thing, USD JPY, base currency USD, quote currency JPY. Okay? Now, what does this have to do with anything? You see, whenever you're trading a currency pair, you are essentially buying or selling 1 unit of the base currency in a currency pair. So if I highlight this particular currency pair, the Euro USD, you notice that at the moment its bid price is quoted as 1.15452. What does this mean? This simply means that if you wanted to sell 1 unit of the euro, okay, you would need to pay $1, $154.54 whatever cents for that particular euro that you want to buy. So 1 euro is going to cost you $1.15448. Okay, it keeps changing, so please bear this in mind. Okay, this is just to make you understand the concepts. Okay, what of the ask price? The ask price is the price which the person who is selling, on the other hand, is asking you to pay for that particular currency pair that you want to buy. So in this case, let's say you wanted to buy 1 unit of the Euro USD. So the person who is selling it for you, on the other hand, that maybe your broker or any counterparty that you're trading with, is asking for 1.15449 at the current price for 1 unit of the euro. You need to pay him that amount in dollars for you to get the euro. The difference between the bid price and the ask price is known as spread. And that is how these brokers get paid. Because when you place a currency trade now, whether you are buying or you're selling, immediately you place the trade, you see a deficit in your account, which is the difference between the bid and the ask price. If price moves in your favor, then part of your profits will go to cover for the cost of the spread. And even if price was to move against you, even after you enter the trade, you've already essentially paid for the spreads because it's factored into your profits and losses. So that is how these brokers get paid. The reason I say this is part of the way that brokers get compensated for the services they offer you, like the trading platform, your accounts, and giving you the ability to place trades in the forex markets and all of that, is because they don't only get paid in spreads, they also get paid in commissions. Some brokers, in fact, will give you the very best spreads. You can see that we almost have a zero spread on this Euro USD for this particular broker. Some brokers will not charge you any spreads. They will give you competitive prices, but they will charge you a commission for being able to place trades that you are trading with them. Okay? So this is how brokers get paid. Okay? So whenever you hear spread, just think about the difference between the bid and the ask price, and that's how they are compensated. Okay? Now, next up, we've got what is known as leverage. What is leverage? Let me put it this way. If I gave you today, let's say you wanted to start a business, okay? Buying and selling oranges, for example. Let's say you had your capital was only 100,000 naira, okay? Now, if you wanted to start this business and your capital was only 100,000 naira, then you can only be able to buy oranges worth 100,000 naira, which you're going to be able to sell in exchange for profits or a small markup, right? Well, this is one of the many advantages of forex trading, because in forex trading, the thing that we refer to as leverage is placed there to help you capitalize on to boost your capital. Okay, so let's say you have the same 100,000 naira in your trading account. So instead of starting a business of selling oranges, you're actually starting a business of trading in the forex markets. Now, if your broker tells you that he's offering you a leverage of 1:100, this would simply mean that every 1 naira in your trading account is going to be able to buy and sell currencies worth 100 naira, because that is the leverage that your account has been boosted with. So in essence, this 100,000 naira that you're seeing in your account, when the leverage is taken into account, this would mean that 100,000 times 100 will give you, this particular 100,000 naira will have the purchasing power of around 10 million naira. So you can buy and sell currencies worth 10 million naira in the forex markets. This is the power of leverage. So even though your capital might be small, because there's leverage on your account, you can buy and sell currencies worth much more than the capital you have in your account. But leverage, as you've probably heard if you've been in the trading industry for some time, is a double-edged sword. The reason why it's called a double-edged sword is that just like you can use it to amplify your capital and make bigger profits from the trades that you take that move in your favor, if you take a trade and it moves against you and you're using very big leverage, your losses are also going to be amplified. Okay, so you need to understand how to use it properly before you'd be able to take full advantage of it. And that's why we always recommend never to risk more than 1% of your trading account's capital on each trade you take, regardless of the leverage on your account. Because if you're trading with an account that has a leverage of 1:100 or even 1:1000 or unlimited leverage, because some brokers offer that, okay? If no matter the leverage you're using, you never deviate from risking 1% of your trading account capital on each trade you take, then this big or small leverage or whatever the case might be is not going to affect you all that much. It's not even going to affect you because you're using proper risk management. The problem arises when your broker sweet mouths you into knowing that you're trading with a big leverage, and then you start trading and risking maybe 20% of your trading account's capital because you can afford to do that since you have big leverage, only for you to risk that much, and then the trade goes against you, and then you end up losing 20% of your trading account on a single trade. That is dumb way to trade. That's not how professionals do it. Okay? So we've talked about all of this. Now we're going to start talking about lot size. Okay? The lot size, as you've probably heard me talk about before, is the unit of a currency that you trade when you place a trade. So for example, let's say I wanted to trade this particular currency pair. When I click on new order, you see where it says volume here. This is where the lot size is inputted, okay? So let's say I wanted to trade one standard lot. One standard lot simply means that if this is the currency pair I'm trading, then I'm buying 100,000 units of the base currency in the currency pair, which in this case is the GBP. So I'm buying 100,000 units of the British pound, and I'm paying for that, or I'm getting paid for that if I'm selling in Japanese yen. Okay, so the lot size that you place here is going to be the lot size that your trade is going to be taken with. And the bigger the lot size you place a trade with, the more the profits or losses that you're going to incur on that trade. So showing you an example again, you can see that for this particular trade which I placed, I placed this trade with a lot size of 0.13. This simply means that I'm trading this particular currency pair with a lot size which is, let's say, 13,000 units of the base currency in the currency pair. So my profits are reflected based on this lot size that I'm trading. If I was trading with a 1.13 lot size, instead of having a profit of $353 that is floating here, this would now be something like 3,005. If I'm trading with a 10 standard lot size, this same trade, I would be making a profit of around $35,000 on this trade right now. So this is one of the reasons why a lot of traders fail, in the sense that they feel that they want to place a trade with a very big lot size because they're going to make big profits. But you should also know that if you're trading with a big lot size and you are ignoring proper risk management, like risking 1% of your account capital on each trade you take, then just like you'd have big profits if price moves in the direction of the trade you took, if price was to move against the direction of the trade you took, you're also going to have big losses, which could simply wipe out your account. So what we don't want you to do is to just say, you know what, today I feel, I feel lucky and I'm going to place a trade with one standard lot, or I feel lucky and I'm going to place a trade with 10 standard lots. No. What you should be doing is consider how much you have in your account, then commit to risking exactly 1% of your trading account's capital on each trade you take. And then when you've done that, you now use a position size calculator to calculate what lot size you would need to trade with, so that you don't risk more than 1% of your trading account's capital on the trade you are about to take, and then take it like that. So whether you're having a leverage of 1:1 million, you are risking 1% of your account's capital per trade. Whether you're having whatever the case might be in your account, you're not just randomly picking lot sizes and trading with them. You are actually making your proper calculation so that you only risk what you can afford to risk without blowing your account, which is 1% of your trading account's capital per trade. And this pretty much brings us to the end of this week's edition of the IT Forex class, guys, because these terms that we talked about today, I know most of you, it's not as if you don't know them, but this was to serve kind of like a refresher of how these terms come together to build a picture of what trading actually is, so that you can have a better understanding and a better use of the terms and a foundation which would help you to build a profitable trading career upon. Okay, but before we wrap up the class, I would like to use this opportunity to also introduce you to our suite of bots which are dedicated to trading on your behalf. Okay, so we've got the ITU, SBT, the Goldmine Pro, and all of this. These bots will analyze the markets and look for trading opportunities, low risk, high probability trading opportunities on your behalf, and then they'll place those trades. And if you use our recommendations, they'll place the trades with proper risk management so that you don't blow your account and you end up making profits properly. Okay, so if you're interested in them, please reach out to us on the socials or drop a comment in the comment section of this channel, and we'd be more than happy to assist you, set everything step by step, so that you can start earning while you're learning. Okay, so that you'd be able to capitalize on the markets and also use a portion of your portfolio for automated trading, while you're also learning how to trade a portion of your portfolio using advanced trading techniques which are manual in nature. So if you're interested in it, please reach out to us on the socials, and we'll be more than happy to assist you set everything up. And with that out of the way, I look forward to seeing you guys in next week's edition of the IT Forex class. And once again, God bless you, thank you, and enjoy the rest of your trading day. Cheers.